then we'll move on to chapter 2. See if you have any questions, if there is anything I left out, or if you have any doubts on any of the material that we covered. Finance is about managing funds, and we manage funds to create value. Okay. What do we mean by value creation? What it means is that based on the risk of an investment, it's an example. If you require a minimum of 8% rate of return, and you're able to produce a 9%, a 10%, you are creating value. Okay? So that's what our job is, to create value, manage funds to create value. These are 3 examples of how we create value when we manage a corporation's funds. Okay? So making good investment decisions, Good projects means investments. Using the right amount of debt, because debt creates value, as you know. Remember that? Because interest expense is tax deductible, it lowers your taxes, you create value. Okay? You don't want to overdo it. Remember, there is a trade-off. For every company, there is a right amount of borrowing. Okay? If you exceed it, then you are destroying value. And then you want to create value by managing your firm's working capital or current assets, Don't be sitting on too much cash, because cash is not a very productive investment, right? Accounts receivable, don't be giving credit to everyone who wants credit from you, okay? Because some people may not pay, so you can create value this way. So inventory, likewise, these are examples of what we do in a business finance class to make our shareholders better off. Okay? And we discussed other branches of finance. So we said don't maximize profits. Do not maximize profits. I remember telling you there are 3 problems with profit maximization. Right? One, of course, is profit maximization. We don't know what profits are. Okay? What we should be doing is focusing on cash flows, not profits. Cash flows. Profit maximization ignores cash flows. What are profits? Remember how GM, gave you more profits? It didn't mean a thing to shareholders, right? They just manipulated the depreciation number. Depreciation is a non-cash expense, so you can increase it, decrease it. It doesn't really make anyone better off or worse off. Remember IBM's example, how IBM was able to maximize profits, bringing, leasing revenue from future years and showing those revenues in the present year. Is that what profit is, How do you know whether next year the lessee will be making those payments, You don't know that, okay? So we said profit maximization has 3 problems. First, number 1, profits are not the same thing as cash flows. So we want our firm to focus on cash flows. Number 2, profit maximization ignores risk, right? And number 3, profit maximization ignores the time value of money, okay? So what should our firm do? Take care of shareholders, maximize the stock price, because they are taking all the risk. They are taking all the risk. Everyone else but your shareholders has a contract with the firm. Everyone has a contract with the firm. Shareholders don't. It's their capital which is paying employees, which is paying vendors, which is helping the communities, okay? So you want to make sure that you reward them, adequately, okay? So how can you cause the share price to be maximized? Remember, Mark Zuckerberg, Facebook's founder, does not have any direct control. He cannot pick up the phone, as I told you last time, and demand that Facebook's share price be higher than what it is. Do I have a Facebook here? No, I don't have Facebook. So do we? Okay, Facebook 166.42. So he may demand, hey, it should be 200, no less than. No, it doesn't work like this. Who determines these prices? As we speak, people are buying and selling. People are traders, you and I, your pension funds, other investors all over the globe, they're buying and selling, okay? So when you buy a stock, you want to see something good happening in the stock's future, right? If you see terrible things happening in your company's future, you're not going to be buying. You'll be selling if you had some of Facebook stock. So when a company is able to show a very bright future, like Netflix, why is Netflix stock price doubling and tripling? I was reading somewhere, had you invested $100 in Netflix, it would be worth, I may be mistaken, I don't remember the exact number, it could be worth $11,000 today. $100 becoming $11,000 today. Why is it so? Because Netflix is growing. It's a great idea. People want to subscribe to, the streaming service, and all over the globe, they are manufacturing, or they are making original content. They are making movies that people like. They're also streaming the content. Okay, so that's why people are bidding up you can say that buyers are very enthusiastic and sellers are not willing to sell their stock. So this is what causes the stock price to go up or go down. All of us, will teach you, what should be the fair value of a share of Facebook. This is what we do in finance. So, but you need to know that it's based on future expectations. If those expectations are great, the stock price will go up. There will be more buyers than sellers. It's a very inappropriate way to express the underlying theme, but this is what it is. There will be more buyers than sellers, and that will cause the stock price to go up. But there is more to it. Okay. So maximize the stock price. All right, and then we covered last time, I believe, this problem. Do managers maximize the stock price, or do they maximize their own welfare? Do they maximize their own salaries and benefits and things of that sort? And this conflict is called the agency conflict. Okay? What is this conflict? Managers elect board members. Let board members hire managers, monitor them, fire them, okay? Approve top managers, policies, strategies, everything. Okay? But then we want managers at the end of the day to do the right thing, make great investments, borrow the right amount of money. Okay, the question arises, do they do it? Okay, it was a huge problem, I can tell you, back in the 60s and the 70s, but the problem has mitigated in the past, decade or so. Okay, so now the board has become more alert. Board members are more alert. They are sued for not doing your job properly. Okay, Sears, for example, as you must know, Sears wanted to go bankrupt. Its founder, agreed to, run it for another year or so. It made an offer to the current shareholders. So there is some sort of deal going on. But there are some people who are saying, hey, Sears board members should be prosecuted for not doing their job properly. Okay, so people are more aware of what the boards are doing. Okay, so this, if there is this and there is this problem, it's not gonna go away, but the problem is manageable, you can say. And this problem, this relationship, the owner-manager relationship, has two types of costs. One are direct costs. Direct costs are when managers draw fat salaries and draw huge benefits, those are direct costs. Indirect costs when they don't do the right thing, sneakily or secretly, or they do things that hurt shareholders, like making bad acquisitions, that help them but not the shareholders, and things of that sort. So what are the possible solutions? We discussed three. One is monitor. Let me ask one of you, what is monitoring? How can we monitor managers? We can monitor them individually, but I must have told you we monitor them collectively also. Auditors. We hire auditors, or the firm has to hire auditors. have the accounts audited, just to make sure no fraud is being committed. Takeover. How is a takeover a solution?